Hello, my name is Clive Corcoran, and welcome to my YouTube channel, the Corcoran Codex, where I look at many critical ideas and episodes in the world of global finance. What I want to look at in this screencast is how to hedge a position, say in bonds or treasury bonds more specifically, by using the various futures contracts that are available for that purpose. The main one I shall look at will be the US Treasury futures contract, which trades on the CME platform, but I shall also touch on the equivalent futures contracts available, say, for hedging German government bonds or even UK gilts. The screencast that you'll see comes from materials that I have been using now as a financial educator for many years, and this material has been presented to banks across the world and central banks, including the Bank of England, the ECB, and other various major financial institutions. On the screen now we can see the variety of US Treasury futures contracts which are offered by the CME Group and traded on their Globex platform. Some other exchanges do offer Treasury futures, but the main one, of course, is the CME Group. So as can be seen, there is a 2-year note, 5-year note, a 10-year note, an ultra 10-year note, a T-bond futures contract, and even a further one, the ultra T-bond futures over here for even longer maturity. The deliverable maturities can be seen here. So in the case probably of the most widely used of these contracts, the 10-year T-note, the deliverable maturities are any bond which at the time of delivery, in the case of an expiring futures contract, would still have at least 6.5 years left to run, and this can be up to 10 years. The primary contract months are based on a quarterly cycle, March, June, September, and December. The trading only now takes place on the electronic platform, the Globex platform. It used to take place as well in the open outcry market at the CME in Chicago, but this is now discontinued and all the trading is on Globex. We can see some other details here. In terms of the way that the Treasury note, let's say, is quoted, it is quoted on the basis of 30 seconds. It is not a decimal-based quotation, unlike nearly all other government bond markets. So if we see a quote, let's say, for 98-16, that effectively is 98 and 16 30 seconds, which of course is 98.5. In the case of a single 30-second at 1% of par, this equates to 31.25. There is also a minimum tick value on that of 1/2 of that amount, as can be seen here. We can see the $31.25 amount there. One of the most important features with regard to the way that one would, say, settle or deliver against a position in the US Treasury futures market is that one needs to take into account something known as the conversion factor. Basically, there are obviously many different kinds of treasuries extant or out there at any point in time, with different times to maturity, different coupons. So in view of the fact that the futures markets require a standardized product, essentially, for the futures contracts, it is necessary to convert a cash bond, one that is trading in the market with these different coupons, as I say, into a bond which is in conformity with the theoretical bond which underlies the US Treasury futures contract. So the 10-year contract allows the delivery of a wide range of securities at the discretion of the short. The person who's sold futures has the option to actually deliver bonds against that contract. They could cash settle, but in many cases there is actual physical delivery of underlying cash bonds. So when a short does make delivery of bonds in satisfaction of a maturing futures contract, the long will pay a specified invoice price to the short, and this will hinge critically on the conversion factor. So the conversion factor invoicing system adjusts the value of the bonds, the cash bonds which have been tendered, by making reference to the notional 6% bond, which is the standardized bond within the futures contract. So I'll show this in a moment when we look at the Excel file, but the closer that the actual cash bond is to this notional 6% bond, the closer that the conversion factor approaches the value of 1. And if the actual bond has a coupon value above, say, 6%, which is in today's markets quite rare to see that, the conversion factor then would have a value above 1, and obviously below 6% it would have a value less than 1. Here we can see some examples of different bonds that were outstanding at some point in the past actually, but you can see this 1 3/4 bond here, which is a May 2022 bond. At that time it had that length of time to maturity, and the conversion factor was equal to that. I shall show in a moment how that amount can be calculated. So far I've talked about the US Treasury futures market, but there are futures contracts on other government bonds. Perhaps one of the better known is the German bund contract. This trades on the Eurex platform, and it represents the German 10-year bund or 10-year government bond. There are also contracts for shorter-term German government instruments. For the bund itself, the contract value is for 100,000 euros, and the tick size is 1 euro cent, and that has a tick value of 10 euros. Similarly to the US Treasury theoretical bond, this also has a 6% coupon, and cash instruments with 8.5 or 8.5 up to 10 years can be delivered against it. There is a similar arrangement for calculating the conversion factor. Eurex actually publishes information regarding the conversion factor and also updates the market on what is known as the cheapest to deliver bond, which is something we're going to look at soon. Other examples of government bond contracts would be the UK's long gilt futures contract, which is available on the ICE platform, and there are futures contracts based on, say, the Japanese government bonds, or JGBs. On the screen now we can see the actual contract specifications for the long gilt. This is the ICE contract. We can see that in the case of this contract, this is based on £100,000 nominal. This now has a theoretical or notional gilt with a 4% coupon. The minimum price fluctuation in this case is 1 penny. Now I want to go more deeply into how one uses the Treasury futures contracts for hedging purposes, and towards the end of the screencast I'll also talk about how one can use these same contracts for changing the duration of a bond portfolio. So before I switch to Excel, I'll just quickly cover what you can see on the screen. So I'm going to talk about the conversion factor, show how that works, and I'm going to explain how we can take these 3 bonds, which at the time this is recorded, all of which are outstanding and all of which could have been delivered against the contract here, which expired in the middle of December of 2017. So we can see here, for example, this is the 2 3/8 coupon. This has a maturity of August 2024. At the time when this was captured, with respect to that delivery date, there were 6 2/3 years left to run. There is a convention within the CME contract that you use a rounding down principle, so I've applied that here. We can calculate the duration of this bond. I'll show how that can be done. We can also calculate the BPV, the basis point value per $1 million of face value. We can convert the value of this bond essentially against a 6% theoretical bond, and from that we can then calculate, simply by dividing that by 100, we can calculate what's known as the conversion factor. And then what I'm going to explain within Excel is what is going on at the bottom of the screen here. So let me now switch to Excel. Let me first deal then with this issue of the conversion factor. As I've said, it is a way of adjusting the value of a bond that is tendered for settlement, let's say, a cash bond, and it makes reference to the notional or theoretical 6% bond, which is the standard in the futures contract. In order to calculate the conversion factor, it is possible to use a built-in function in Excel. So I shall show it here. It is this function of PV. Notice the negative sign I have there. And there are various parameters that are required. These parameters can actually be identified within Excel, so I'm not going to go through them. And once we plug in these parameters, which essentially make reference to the notional bond, the fact that there are two payments, semi-annual payments, and the face value of the bond and so on, we can actually express the value of this bond as if it had a 6% coupon. And it turns out to be that amount. If we then divide that by 100, as I indicated, this is the conversion factor. All of that can be done simply by knowing the coupon and the maturity date and applying the rounding down, as I mentioned. So I've been able to calculate the conversion factor for each of these, and they obviously do conform with the actual documentation, say, provided by the CME group. We can also use, although this is not quite as accurate, we can also use the function in Excel called duration. We do need to know what the current yield on these bonds would happen to be at the time when this was done. So these are close but not exact. We can also go on, and in fact I just simply took the BPV values from the CME document. Theoretically that could also be done probably using Excel formulae, but it would be rather complex, and I decided to simplify by simply taking the values from that CME document. So this particular bond has a BPV of $637 per 1 million of face value. The key idea that I want to address now is how could we use a 10-year Treasury note futures contract to hedge a particular bond. Obviously one would probably be looking to hedge a portfolio of bonds, but we're going to take a very simple example of a single bond. One important stepping stone to this is to calculate what is known as the cheapest to deliver bond, and that takes into account all the various bonds that are available and eligible for delivery. I've already covered that earlier. And to find out which one has the lowest basis, or in other words, the highest implied repo rate. So the first point to notice is that as of the settlement date here, the actual settlement price was this amount here. So the actual prices of the bonds can also be found from the CME document. The conversion factors are essentially the same values there, and I've already discussed how those can be calculated. In order to determine this CTD bond, or cheapest to deliver, we need to apply an adjustment to the settlement price here, the futures settlement price, based on the conversion factors for each of the three bonds. So, for example, here, what I've done is take this value here, which that cell is called settlement, and I've multiplied it by the appropriate conversion factor, which of course is the same here. And now, based on this little bit of logic here, so the short is going to receive the settlement price multiplied by the conversion factor, what we've just discussed, plus accrued interest. We have to take into account the fact that the bond will have earned some interest from the period when the last coupon was paid. And this adds another kind of element of complexity to the calculation, but it is relatively straightforward. We can see that the cost, the dirty price for this bond, in other words, the clean price plus the accrued interest, is here. And the idea for the cheapest to deliver bond is that you want to minimize the difference between the quoted bond and the settlement multiplied by the conversion factor. So I've actually done that here, where I've essentially subtracted this bond from the adjusted futures bond, and I've also turned that into 30 seconds by dividing by this amount here. So in terms then of, so for each of the bonds I have done, for each of these three particular bonds, I've done the same thing. You can see here that the basis really is at a minimum here, where there essentially is 3.830 seconds difference between these two prices. Now, if I multiply 3.83 by the $31.25 that I had mentioned earlier, the cost effectively to deliver this particular bond against the settled futures is this amount, which of course is the minimum of each of these amounts here. And we can also take a different approach, which is to go ahead and calculate accrued interest, look at the cash flows involved in purchasing this bond and delivering it against the futures and annualizing that as a rate, and we end up with what's known as the implied repo rate. And it can be seen again based on these numbers from the CME document. This particular bond has the highest implied repo rate, which is in essence another way of thinking about the fact that this is actually the minimum basis amount in this column here. Once we've identified the cheapest to deliver bond, we can then populate this formula here, which is the key hedge ratio formula. So we can see we're making reference to the conversion factor of the cheapest to deliver, the BPV of the hedge, BP of the bond we want to hedge, and that's divided by the BPV of the cheapest to deliver. So now that we've identified the CTD, let's now assume perhaps that we want to hedge this bond here, which is the May 27 bond with, again, a 2 3/8 coupon. And let's suppose we want to hedge $10 million of that, a $10 million exposure. So the BPV for this bond would be to take this number here, multiply by 10, since we have 10 million. So the BPV is $8,558 per 10 million face value exposure. The cheapest to deliver security, we've already talked about that, and we know what the BPV of that is. But we need to think in terms of the contract, which has a $100,000 face value. We know that the conversion factor of this bond, we've already calculated that. So if we plug in the values into the formula here, as along this row here, we can see that the hedge ratio for this particular exposure is 108 contracts. So in other words, if somebody has $10 million of this bond, they want to hedge the price risk for this bond. Going through all the calculations, we know that they should sell 108 contracts. What's on the screen now is essentially what I've just covered within Excel. I want to talk a little further about the implied repo rate. So prior to a particular futures delivery date, market participants, practitioners can identify the cheapest to deliver bond, which you can see why that is important with regard to the hedge ratio, as the one with the highest implied repo rate. The implied repo rate is the hypothetical rate of return earned from buying a deliverable bond, selling the futures, and then delivering the bond into the futures contract on some assumed date. The calculation must include the accrued interest on the cash bond and the futures contract, and this is determined with reference to the number of days that have elapsed from the payment of the last coupon. In other words, it's the dirty price. The final point I want to cover briefly in this screencast is how to change duration of a bond or bond portfolio, more likely, by using futures contracts. So this actually represents a different set of bonds than the ones I was referring to earlier, and in fact actually makes reference to a CME document which explains their hedging processes, which was released some time ago. These are the bonds that they were using in that particular explanation. But the important formula is down here, so I just want to quickly explain the basic mechanics of this. Let's assume that a bank has a $100 million bond portfolio with a BPV of $80,000. This has been calculated. The bank is concerned about interest rates increasing and thereby the price of the bonds decreasing, and wants to adjust the duration of the portfolio downwards from its current duration value of, say, 8 years to 6 years. This would help to reduce the market risk for this particular portfolio. So the key idea is to use the formula here, and the hedge ratio now is we take these values, as can be seen here. Once again, we're making reference to the BPV of the portfolio, which we know, the BPV of the cheapest to deliver, and the conversion factor of the CTD, all of which have been explained. We can see here that we, let's say, plug in these values here. So this is the target duration of 6. This is the current. We divide by that. We take the BPV of the portfolio based on the values up here on the screen. We plug in these values here. It turns out that for the fund manager, without having to change the actual composition of the underlying portfolio, would be able to reduce its duration to 6 years by selling 244 contracts of the cheapest to deliver bond. I hope very much that you found the subject matter for that screencast to be interesting and useful. And could I suggest perhaps that you subscribe to my channel, the Corcoran Codex, because I will be adding more material along the same lines in terms of critical ideas in the world of finance. Thank you very much for watching.